52% in 2020 sure was an eye-popping return, but of course, the pandemic created a lot of opportunities. Here we are in March of 2021 with a vaccine rollout well underway. How much dislocation is there really now in credit, and where are you finding stuff to do?
Yeah, I mean, there's still opportunities in credit. And I think if you live at the 50,000-foot view, spreads are tight, and they're really tight. But I think as you get down to the ground level, there's a ton of dispersion, both on the fundamentals of the underlying businesses and also on the returns. And I mean, you just look at high yield bond market in 2020, it returned 6%. If you look at it on a sector level, there was a 19% delta between the best performing sector and the worst performing sector. But more importantly, if you go down to the subsector level, it was a 98% delta between the best performing sector and worst performing sector. So you just have to be agile, you gotta be nimble, you gotta be flexible. And we really think it's a market about being active versus passive.
If you're an opportunistic investor, which is what you are in the Dislocation Fund, is there anything to do in liquid credit, or are you having to do things elsewhere? And if so, what?
Yeah, there is still stuff to do in liquid credit, but we're also seeing a ton of opportunities in illiquid credit and private credit and real estate credit. And the fund you mentioned, our Dislocation Fund that we raised this spring, about 40% of deployment in Q4 alone was in the secondary markets. And I think a big part of that is unique sourcings. That strategy sort of sits in the center of everything that KKR is doing. And we have hundreds of investment professionals across 20 offices really sourcing all these unique opportunities that either unique risk reward, dislocation, dispersion, which we really think is truly differentiated. So it's just you have to work a little harder.
You mentioned private credit. Tell me about the visibility you have through KKR's private credit portfolios. Does the number of loan amendments you're seeing and the PIK substitutions for cash interest payments suggest maybe that there's more hardship there than the bond market might suggest?
Yeah, I definitely think if you look at what the Fed did and how they stepped in, they definitely protected the large market. They did what they said they were going to do. They stabilized the capital markets and the public markets. But it's still unclear on where all that stimulus is going in terms to the small middle market and the smaller businesses, and particularly even the syndicated loan market. A lot of them didn't get access to that capital. So, it's very idiosyncratic risk where we're seeing amendments and picking interest and the like, but we definitely see, more sort of strain in the illiquid markets than we do necessarily the public bond market.
And on balance, how is private credit performing relative to public credit?
Really well. I mean, it's performing. Our portfolio has done really well. We had a handful of things we've needed to sort of support, but we were really well positioned coming into this. Now, there's definitely a lot of private credit companies still seeking capital solutions. And so if we look at our sort of dislocation capital and our rescue finance opportunities, our pipeline is growing meaningfully as a result of many of these businesses that didn't really get bailed out.
Chris, the story of the year so far in credit is that court ruling against Citigroup in the Revlon dispute transfixed people, in fact, surprised many. In your mind, was that the right outcome?
It's a good question. It's a tricky question to answer, not being, part of that litigating party. I think it did definitely surprise. I was surprised by the outcome. But you haven't seen sort of broad market fallout as a result. I think still people are processing, discussing it. And I think there'll be some broader implications to the broader syndicated loan market as a result, particularly if you're an agent.
Such as what?
I mean, the risk of accidentally sending money to pay off something and then not being able to get it back. If you're the agent and made that accident, that's risk that you didn't think was risk there before.
Are they going to try and transfer that risk to the, to the client?
I'm not sure. I'm not as close enough to the situation on the specifics, but that could be a case.
Chris, there was a scare of sorts, right, in the bond market last week with yields ticking above 1.6% on the 10-year. How are higher yields and the threat of inflation changing the way that you're making investment decisions right now?
We're definitely monitoring rates, but for the most part, credit has held up extremely well, despite the move in rates. And I think there's just a massive demand for yield and a good tailwinds for credit in general. But we're definitely paying attention. We track every high yield bond that's in every high yield ETF or mutual fund, and monitoring the book, repositioning the portfolios as a result. So we're definitely monitoring the more rate sensitive, longer duration.
What,
The areas that are getting nicked up a little bit more.
Let me ask you what you're concerned about, if you will, most. Is it what the Fed might say about the level of support that exists or doesn't for the corporate bond market? There were some big programs put in place in the spring of last year. Is it sort of the fragility, if you will, of the high yield market with so much of that in daily liquidity vehicles like ETFs and mutual funds? What do you worry about?
Yeah, I do worry about that. I mean, a big part of the high yield market is as you mentioned, in those daily liquidity vehicles, and we estimate it's around 40%. And those are definitely going to be much more equity linked, or out correlated to closer to a correlation of one when we see messaging around the Fed. Now, I'm not worried about going back to volatility we saw in the spring. And if anything, any type of fear around a taper tantrum is probably more of a net buying opportunity. I'd say my biggest worry is making sure we have the liquidity to play offense when all others are playing defense.